please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Nifty Bank at the moment is outperforming mildly the Nifty, which is actually to be counted as flat and not really as lower. It's only about 0.1% lower. That sets the stage to invite our market master for the morning. Tushar Pradhan, CIO of HSBC Global Asset Management, joins us on the show. Good morning, Tushar. Always a pleasure having you with us. What has the results season so far told you? Are the earnings on at least mending their way up? Do you think there are lower downgrades this time, and that enthuses you to pick up stocks?
Well, actually, the earnings season so far has been thankfully on expected lines.
Okay.
So what was happening after the first quarter was that we understood that the disruption in earnings is likely to continue into this quarter. And as a result, what we thought of was that this quarter was not going to be something to look forward to. And I think more or less, if you look at the mixed nature of the results, obviously there are some companies which have done very well, and there are some companies which have kind of surprised on the downside. But I think overall it is more or less on expected lines, which again gives us some confidence that this recovery is likely to come in the third and the fourth quarter. So in a sense, there is a base effect at play here. If you remember, third quarter of last year was an extremely difficult quarter. And on the mend, most of the companies are likely tend to, on a YOY basis, show a pretty stupendous number for third quarter. And then if the momentum continues into the fourth quarter, we should have a reasonable year. And I think that should set up nicely from a sentiment perspective to think that FY18 was a good year, and then, or let's say a normal year, and then expectation of FY19 to be much better will start to build in. So I think overall, not really disappointed with quarter two earnings so far.
Okay, not disappointed. Tushar, good morning. But in terms of portfolio approach from here on, how are you positioned? Still overweight on financials, consumption, which has been really the big theme for this market?
Yeah, so I think there is a bit of cyclicality which is looking attractive. So you've seen commodity prices harden, you've seen some sort of normal nature of an economic cycle start to pick up. And if interest rates continue to remain low and inflation undershoots, then we are what is known globally also as a Goldilocks economy, where there is growth and there is very low levels of inflation and interest rates. And that actually is quite amenable for stock prices as well. So from a portfolio perspective, I think some sort of cyclicality is something which is looking very attractive. And of course, the cue has been given by the very strong surge in banking stocks. And obviously the funders of the economic cycle obviously do get rated or re-rated first. All of the ordering, all of the infrastructure spend also talks about a basic level of involvement in the real economy, which hopefully over the next few quarters should tell us that there is a cyclical upside. So I think in addition to financials and consumer discretionary, I think a little bit of materials, a little bit of industrials, I think is something that portfolio should start looking good at.
That's an interesting point, Tushar. That the portfolio sort of composition now changing a little more towards the economy-facing side of the market. What are you looking at? I mean, what parameters are you going by when you're selecting companies in this pocket? Are you looking for order book visibility? Are you looking for, balance sheet improvement? Are you looking at margins? How is it that the needle kind of tips in favor when you're looking at either EPC, construction, or even power utilities for that matter?
That's an interesting question because it's not that easy an answer to give. I'll tell you why. Even if you look at an EPC contractor, say for example, there are kinds of EPC contractors which have either a quicker turnaround in terms of revenues, or if it's an EPC contractor for a project which takes, like a hydro project for example, take 5 years or 6 years, then looking at order book really doesn't translate into some near-term excitement, and we don't really know what is the level of completion and how the revenue is booked. But overall, when one looks at attractiveness by way of which companies will do better than others, I think one should look really at a timeline. So initially what tends to happen is the initial initiators, I would say, of EPC work, which have a 6 to 8 months kind of turnaround time, are the ones which look best. So which means, just to give an example, if you're a construction-oriented person and looking for attractiveness there, then people who are in the piling business, people who actually go and dig holes before the actual structure comes in, they also are very specialist EPC contractors. So such kind of companies which really front-end the infrastructure spend tend to benefit the most, and the order inflow and the turnaround is very quick for them. Then you go into the second stage where you've got, the total EPC contract of steel, of all of the other structures which come up after that. And eventually the whole project, once it gets approved, then it's the total EPC contractor who actually makes the money over this period of time. So I think while one can make a very quick response to say, okay, EPC in general, I think one has to dive deeper to say which companies actually benefit at what time in the chronology over which the infrastructure spend actually happens. So I think there's plenty of opportunities to look at, and we keep doing that to kind of see which will hit the revenue first.
Okay, fair point. That's helpful, and perhaps we will take some cues from what you said. Well, now another macro theme, crude prices have risen and so have Indian bond yields. Does that change your stock picking? If yes, how? As well, in the list I have HSBC Equity Fund, Mid-Cap Equity Fund, India Opportunities Fund. There is no whiff of even an SBI, so no PSU bank. Will that change? Or has that changed?
Well, actually, that's been a revelation of sorts, in the sense that obviously the market has reacted to say that things are all pretty okay, because if you look at the valuations, the very quick and sharp correction, things are all pretty okay, because if you look at the valuations, the very quick and sharp correction within a few days tends to kind of take a view that everything is okay. As we've seen, prices have started drifting lower back, with the reality that this package has some steps to it. It's not as if the banks are going to be in the pink of health in an instant. It is going to take time. It is going to be selective. There are certain banks which benefit better or more than other banks. So I think this price correction will take some time to kind of get settled into the prices. On the other hand, we continue to believe that the overreaction to say that now that the public sector banks are healthy, NBFCs will lose market share. I'm not really someone who subscribes to that view. Okay. Simply for the fact, because I think that the expansion in the market is what the NBFCs are targeting. They are not taking market share away from the public sector banks to begin with. And there is a clear distinction between corporate lenders and lenders to smaller corporates as well as to individuals. So that's where most of the NBFCs really focus on. So I think our focus continues to remain more profitable, lesser, lesser, let's say, exposure to corporate banks. I think that continues to remain. We are not really going away from that.
But that was actually
that was both of us had the same question.
Yeah, that was my follow-up question, because I saw a lot of NBFCs on your list, so I'll avoid that, Tushar. The other interesting bit that I want to ask is IT quietly has had a decent rally this year. In fact, some of the top gainers are IT stocks like Wipro. You have Infosys, of course, among your top holdings. Are you looking to buy or add more of IT in your portfolio? Well,
what we've seen is obviously over a period of time, the IT companies have had their share of pretty depressing news. And I think as all cycles do, they start to flatten out after some time. What we see is continued GDP growth rate in the US. The economic macro essentials continue to remain pretty positive. So much so that the hardening cycle next year could possibly be something which we now have to take as a reality. All that is telling you is that the US corporate environment is in great health. And I think that's also sounds good news for Indian IT companies in general. In the past, they've had some issues in terms of managing their growth, because that's much lower than historical levels of growth. And I think they've done a lot internally to readjust their business offerings to ensure that they are now much lesser cost. They've done a lot of adjustments internally. So I think it's about time to kind of say, well, they are relatively now cheaper, not only by way of their historic valuations, but the fact is the rest of the market has become horribly expensive. So I think, these seem a reasonable bet now, as opposed to saying, oh, these are the new growth areas. I'm not saying that they are going to go back to those growth rates. But I think at least on a relative basis, the value is emerging in IT as well.
All right. Tushar Pradhan, it's always a pleasure having you with us. Thank you very much for joining us and delineating all your macro and micro themes. Okay, it's earnings season, so a lot of corporate results have to be analyzed. Intellect Design is the stock on our radar. The company posted a strong set of earnings in the second quarter. Margins as well improved. The traction in the banking and finance, BFSI space, is showing up in the numbers. Arun Jain, Chairman and Managing Director of Intellect Design Arena, joins us now. Good morning, Mr. Jain. Thank you very much for joining us. If you can take us through the quarter that was, especially the gains made in the BFSI space. Of course, the order from BDO Nomura for trading solutions, is that already included in this?
Yeah, that's included into it. So,
okay.
So let me just take you through the journey of Intellect. I think this quarter is given 21% growth year on year on dollar terms, so $41.75 million revenue. When we started our journey, was $25 million per quarter. I think it's a substantial shift. Second thing is we are the ability of the company to win large deals.
We are back with Mr. Arun Jain, Chairman and Managing Director of Intellect Design Arena. Mr. Jain, you were telling us about your second quarter. If you could also elaborate on what was the reason for the margin improvement? Did you take any wage hikes, and is this margin improvement despite the wage hikes?
Yeah, I think let me just tell you the story of Intellect to the investor, which is looking for predictable, profitable growth, because this sector is a new sector in the journey of Indian IT industry. We are in the fintech space, so this 21% growth in this quarter, and last year also was 22% growth in last quarter, so half yearly we grew at a 20% rate. It's coming from 12 deals we won during this quarter, out of which 3 are transformational deals. The transformation deals are very difficult to compete against global competition. So one has to appreciate that in government e-marketplace, which was a global tender, we won against a global tender e-marketplace, and which as a government has to look at it, 400 to 600 crore coming next 5 years through this portal. So that's a deal, $100 million kind of a deal. Then we have a deals in Thailand, Bank of Thailand for their digital transformation, Bank of Bangkok, which is the largest bank over there, to win in that marketplace against global competition. And then one of the largest top 5 Bank of India has chosen our digital transformation. Yes. So all these 3 deals are very, very interesting deals which are catapulting the company into a new space of global leadership. So Gartner has positioned Intellect as the #1 in global transaction banking services with open banking and API services, which is a great credential, because Gartner, when they say it's a global #1, it opens up the market of $25 billion money which banks spends on corporate banking space, and when you are #1, we have got a good pipeline going forward. So these are the very positive investment what we spent in last 3 years is translating into the outcome. On margin improvement is a outcome of our license revenue. Our license revenue has gone to cross 100 crore in this quarter, 105 crore license plus AMC. So 60 crore out of which is a license. And from last year, same period, we have added 31 crore into EBITDA. So we added 37 crore in revenue terms, but 31 crore came into EBITDA. So obviously the license directly goes into the bottom line. So that's a nature of the business we are in, that our margins are not sequential, linear. So when we try to analyze with IT services company, it's very different from that space, Lata.
Okay. Can you tell us the contribution that BFSI is making to the total top line now? I mean, I'm talking more from an annual basis as well, because that's a huge segment for you. And what is the growth this time around in BFSI for you?
Its entire thing is a fintech space. Now, BFSI has been redefined into fintech space. Entire revenue of 1,000 crore now. The company has crossed 1,000 crore run rate. Last 6 months, we did 500 crore plus. So we are the largest fintech company in the country, or almost in the world, where we have a latest platform. So I think that's the entire space is fintech space is there.
Okay. Point taken.
100% revenue is coming from that.
Mr. Jain, what is the
sector we are catering to?
No, a point taken. It is an entirely BFSI space. What is the domestic export split? And you spoke about getting one order from one of the top 5 Indian banks. So what is the rate of growth in India that you can forecast?
India market, I think Intellect is present in Reserve Bank of India, giving the technology infrastructure, now government e-marketplace, NABARD, LIC. So we are partnering with most of the Indian corporates. So growth rate in Indian market is coming up. And the problem of payment, delayed payments, I think those are still persisting in government of India or persist in Indian market or Asian market. So our collection days becomes difficult. But overall, since we are belong to Indian market, I think Indian market in private sector is really rewarding, and growth is, they are adopting the technologies. So technology spend in private sector are increasing substantially. I would still like to see that public sector banks spend enough money in technology. They are, to me, are quite laggard in investing into the technology space. So that's
absolutely, Mr.
I think
Jain.
there's a big opportunity when government has given a good money to them.
Oh yes, recapitalization. Maybe some of that money goes into upgrading IT systems, and for PSU banks, of course, that perhaps could be a great kicker. But finally, sir, can you leave us with some sense of guidance for the year as a whole? And also, will most of this growth be volume-led, more and more contracts getting added? Or are you able to price your service offerings higher as well?
Yeah, I think for predictable growth, instead of giving a guidance, I will give you predictability. Predictability is coming in our business coming from, because market is buying more than build. So the service revenue, which used to be higher, now it's going to buying decisions, buying the ready-made products. Second thing is our competition is becoming consolidated, and we are visible against Finistra on one side, FIS on other side. So this is and Temino. So there are three players, and Intellect is the fourth players emerging. So our competition landscape is converging into 4 players. And then our funnel is on 28 destiny deals. We have 28 destiny deals, which is more than 3 million, 20 crore rupees to 50 crore rupees, or more than 100 crore rupees. So all these deals are getting decided. So around 5 to 6 deals are getting decided per quarter. Last time we won 3 and we lost 2. Okay. Let's hope if the pattern continues, that's where our major predictability will come in going forward.
Okay, Arun, thanks a lot for your time today. That's the Intellect Design, good numbers and strong management commentary. Of course, the demerged arm of Polaris and now doing well, the services arm. But Mahanagar Gas posted a weak set of earnings in Q2. Rajiv Mathur, MD of Mahanagar Gas, is with us. Mr. Mathur, good morning. Can you run us through the Q2 numbers, especially in terms of the volume growth?
What I can say is that, this quarter has been reasonably good as far as the financial numbers are concerned. Although we had an overall growth of about 4% in volumes, the PNG volumes actually grew by over 6.3%. Especially the piped gas customers, the volumes rose by 11%. The commercial sector also grew by about almost 6% or so. Although the industrial sector, the volumes were flat in this quarter. And CNG sales grew by about 3.5%. Some of this we can attribute to the economic activity which emanated out of the rollout of GST in this quarter. And our expectation is that going forward in the next quarter and in the next 6 months, the volume growth should be much more than what we've been able to achieve in this quarter itself.
Okay, so the company has reported about 40% volume growth, or rather 4% year-on-year volume growth. And we've been waiting for MJL to show a volume growth of now at least, in the high single digits, maybe 8 to 9%. Is that something that is achievable? Because we've not seen that, sir, in the last couple of quarters. Do you see yourself going to the high single digits, perhaps this year?
You see, where IGL differs from us is they have the regulatory and the support of the legislature as far as mandating people to use CNG is concerned. Whereas in Mumbai, it's entirely on a voluntary basis. So considering, the number of vehicles that get added, the urge of the people, the economic compulsion for people to use, the growth rate is definitely lower than that of Delhi. But by the industry standards or by the rate at which GDP is growing, we are, in consonance with that. This is all I can say.